Welcome back to the SteadyTrade Podcast, everyone. Listen, I want to start right out with, as I mentioned, typically at the end of every episode, we're listening to you. And a lot of you have asked that you just want us to get right to the content, get right to the data right away. So I'm listening. I might not appear like I'm listening, but I am. Now, I will say that, since we relaunched the podcast, I did do longer intros on the other ones just because I wanted to kind of get all of our longtime subscribers up to speed. But that being said, listening to the listeners, let's get right into it. So the topic for today is basically wrapping up the first half of the year. We're heading into the 4th of July, the best year of all year. I often say history began on 1776, July 4th. Everything before that was a mistake. But that being said, welcome back, Matt, my man. We got a bunch of stuff to go over today.
Yeah, we do. And we're going to have a lot of different backgrounds for me in the next few weeks. I'm in Lisbon right now, as you know. So I'm here in some conference room. And
fleeing from Interpol currently? Or
fleeing from Interpol. I just let them know where I am, so I don't know if it's going to go too well. But here, so if I have my voice a little weird, overnight flight kind of gets me sometimes. So we're all battling something here today. But yeah, I think, Tim, this show should be a little bit of probably maybe half and half. We'll take a look back at the first half because you always have to learn from history, right? History, you have to look back, and you can't drive a car looking in the rearview mirror, so we need to look ahead as well. So we'll look back at what happened and kind of, break down what we thought was going to happen and what really happened in the first half of 2024. And then let's look ahead and get my view and your view of where we kind of think things are going big picture. We're not going to break it down in specifics, but maybe some big picture stuff. So if we look at the first half of the year, you're probably like me, overall, the numbers were great. We had the NASDAQ up 17%, the S&P up 15%. Dow lagged behind. It was only up single digits. Keep in mind, Dow's only 30 stocks, a little bit different of a weighting.
Right. That's one of the reasons. Like when people ask me about indexes, I'm like, I know the Dow is like the Dow, like especially if you watch the mainstream. But I'm like, I just can't remember 30 stocks. Like that. Yes. That's why I only track the S&P and the NAS. I don't even. I used to, like when I was a newbie, I would follow the Dow, but I'm like, to me, it's borderline worthless. So
it is, and but the Dow is like the first index ever, basically. It started down in Wall Street, and it's got this flair of it's a lot of history involved, and it's never going to go anywhere. And I'd hope it doesn't. But again, reality, in like when I manage money, you never use the Dow as your benchmark. It was usually the S&P 500. You don't use the Dow because you're looking at 500. However, if you look at, how the equally weighted stocks did this year, so far the first 6 months, the RSP, which is the ETF that tracks it, only up 5%. So if you look at the S&P up 15, equal weight S&P up 5. So that means that the S&P, as we've talked about before in shows, Tim, it's so heavily weighted into the big guys, the Apples, the Amazons, Microsofts of the world, that it's really deceiving. So I think really if you want to see how the overall market's truly doing, you probably look at the RSP and it's only up 5%. So people are out there saying, well, too much, too fast, we went up too much. We're only up 5%, which really annualized out is about 10%, right? Which is about in line where the market's done over the last 40 years. So we're kind of right in line, strangely enough, even though you think things have gone. The semiconductor ETF, the SMH, up 49% in the first 6 months. So there was pockets of strength. And there's pockets of weakness too. So I think we need to keep that in mind when we look ahead and when we look at our portfolios. We can't just look at, I must be doing bad because semis are up 49%. No, the equal weight's up 5%. So if you're up 5-10%, you're basically in line with the market, maybe beating it.
Right, and like what I just love to see, again, as more of a day trading focus, I just love to see the big gains, especially in like the S&P because. Like if you're a day trader, what's nice about that is, that creates hype, that creates momentum, that creates dollars flowing into the market. And like the more people see that all-time high, that's where, we mentioned in previous episodes, like it reminds me so much of 2020 when you got so much FOMO coming into the market. And at the end of the day, again, from a day trading perspective, like we love the people filled with FOMO, the people with the get rich quick mentality, the people with no knowledge of anything, just chasing stocks up because as a day trader, you love to sell to those guys. So the more these indexes hit, that's why you see all these penny stocks popping off. Like, it's a separate, and actually I'll make a point. Well, I'll get a screenshot of this. So we have a day trading algo at StocksToTrade, and it identifies like, these low float, big movers and stuff. And what's crazy is it's detected 44 triple digit movers this year. Now, the reason I bring that up, going back to last year, the whole year there was 37. So basically, when you look at the number of these penny stocks popping off, and to me, it's a big reflection of the fact of the indexes of the real companies, because then the uneducated and the get rich quick people pile into penny stocks.
And what's weird is, even though you've seen these big moves in penny stocks, the S&P small cap 600, which is 600 small cap stocks, so it's a really wide-ranging index, down 1% in the first 6 months. So, I'm looking at a kind of a heat map of the first 6 months between countries, different sectors. And, typically when you have the S&P, NASDAQ trading at or near all-time highs, you're going to see most indexes, like the rising tide lifts all ships. We're not seeing that this year. We're seeing a real bifurcation of the market where if you look at like even value, the S&P 500 value is up 5.6% year-to-date. The small cap 600 values down 5%.
Yep.
So if you're investing in small cap value, which over time typically does very well, and we had a show a couple of weeks ago about small caps, Tim, and we talked about the opportunity there, and I think there's great opportunity. The momentum right now is obviously the mega caps, and that's gonna continue in my opinion. But there's going to be a shift to small caps because eventually you're going to see such great value that you can't ignore it anymore. You're going to see money start coming in there. So I think we'll get to this in a moment, looking ahead, we need to keep in mind, small caps are really, valuation-wise and technically speaking, look attractive to me.
That's why you're the best podcast co-host in history, man, because you do exactly where I was going. So obviously this is, we're reviewing the year, but that is exactly kind of what I was getting at, is like the fact that, going back to that stat I just gave, it's like, man, I just think we're getting started. Again, I know we're kind of evolving the podcast ideally to a more diverse audience, but like if you've been following back in the years when we were exclusively penny stocks, man, when I see exactly what Matt said, I'm like, man, talk about licking your chops.
Yeah, the opportunity is there. I mean, it's given to us on a silver platter. Could small caps lag for another 6 months, another 12 months? Sure. But I think if you're a long-term investor, you want to start putting some money away in small caps and start allocating a little more, because you're probably well under allocated when it comes to small cap stocks. And if you're day trading, I mean, your eyes should be this big, knowing that, wow, when these small caps start taking off, that's going to put a lot of money into a little bit more, quote unquote, riskier stocks that maybe aren't, generate as much revenue that people will jump into. So I think we're setting up for a great multiple year run for small caps, which again is good for me because I like looking for under radar stocks, these hidden gems. And for you, it's great because you're following these small cap stocks, and more money going into there means more liquidity for you and more upside potential as well.
Now, one thing I want to just jump back to the S&P real quick, because and I told the story a couple episodes ago about, October, and I was crazy bullish, and everyone at that conference was talking about the end of the world. And I'm like, man, hold on. But, when I brought up the stats you had, and I'm like, 15% year to date on the S&P. I mean, like, I never expected, I knew it, but like going back to like October, I didn't expect that. And I guess I'd like kind of your read on that. Like, what do you think's going on there when the economy is an absolute disaster? World War III could break out while we're recording this podcast. Like, what in your opinion, what's going on there?
Well, I mean, I think a lot of it's being led by obviously these mega caps and the AI trend. The AI, is increasing productivity. It's increasing margins because you're getting more productivity with less money going into it. So your margins increase. And you know what? At the end of the day, these large cap stocks are profitable. And you're looking at the free cash flow for a lot of large cap stocks are the best level we've ever seen. So they are generating a ton of cash. So I think that's what's really bringing things up. And there's the hype around AI, which, any major mega trend, when I say mega trend, I mean something that lasts 15, 20, 30 years, maybe, decades. In the beginning, we get overhyped, right? It gets overhyped. People think it's going to change the world tomorrow. Then we have this kind of usually 6 to 12 to 18 months where that trend just kind of goes down. And then you start people saying, well, it's over. It's just a fad. Well, AI, we know is not a fad. It's a trend. So in the short term, we overestimate the impact of a trend, this being AI. In the medium term, we underestimate the long-term impact. So eventually, a lot of these stocks that have run so much will pull back and be great buying opportunities. And a lot of small caps that haven't run yet, that are related to this trend, haven't run yet either. So I think there's some great opportunity, but it's being led by mega caps. But the next big leg higher will be led by the masses, the other companies, the secondary, tertiary plays off AI that have not yet attracted the big money. That money will shift. We're going to see a shift of money in the very near future, in my opinion.
And that's what I think is so cool about AI, both from a tech, again, my bio, listeners know my bio, but I've always been a tech guy back to second grade, setting up an Apple II, okay? But that's the one to me, living through all these trends, whether it be the emergence of the PC, and again, I had an internet company doing dial-up internet, okay, that's how old I am, and then the iPhone and stuff, to me, that's what's so exciting about AI is it's not just in some stuff, it's in everything, and that's why I think, to me, there's times I think the hype isn't enough, because you just look at where we are. I mean, we're basically, a year and a half into mainstream AI. And at StocksToTrade, I mean, we have people every day using this stuff, and like real world applications. And that's across basically everything. So that's why I think if anything, I think it's all the AI hype out there. I think it's a little underplayed myself.
Yeah, I agree. Long term, it is. I think it is. And I think short term, it's a stock by stock basis a lot of times on valuations. NVIDIA's been a poster child, as we've talked about before, and it's had a hell of a run. It was up 150% in the first 6 months, which is mind blowing for a $3 trillion company now. Obviously, not that big, but it's still a $1 trillion company beginning of the year to be the best performer. Normally, the big guy like that of the Russell 1000 stocks, the biggest company, or second biggest company, isn't going to be the leader. But it was a leader. So it just shows how strong. But if you look at the projections for revenue and earnings in the next few years for NVIDIA, if you look out a couple of years, I don't want to say it's cheap, but it's definitely not expensive. So there is definitely a huge upside if they hit these numbers. And I think they probably beat these numbers. And if you look at the Russell 1000, and I took a look at the top 30 stocks in the first 6 months of the year, and I looked at the top 10. Top 10, 5 stocks in the top 10 are AI related. Number one being NVIDIA. Vistra, which is utilities, but they deal a lot with the data centers, was number 2, believe it or not, up 123%. Pure Storage, another one, was up big. That was up 80%. We talked about this stock, I think, in the past, VRT, data centers, up 80% as well. And then CEG, which is Constellation Energy, which is a big nuclear energy, which again, with dealing with data centers and demand of energy for AI, up 71%. That's a freaking utility. So it's kind of mind-blowing to see, what is in this top 30. But what was kind of cool looking at the top 30, Tim, was there's a couple other areas that were represented that you may not think of. Broker dealers, Robinhood and Interactive Brokers, both in the top 30. Consumers, we had Kava, which is like a salad place. We've probably been like a little fast casual restaurant. Wingstop, Wings, Crocs, those ugly ass shoes. Fresh Pet, that's your pet. Dick's Sporting Goods, golf and shoes and athletic wear, top 30. So it's kind of odd to see that it is diverse, which I like that, because a lot of people say, well, it's being led by the big ones, which it is. We just talked about that. But in the top 30, it is a diverse market, and that's a good sign long term. The one sector that was not in there was biotech. And typically when you have a strong market, the biotech's doing well. But because the Fed hasn't lowered interest rates yet, I think biotech's lagging. And when they start lowering interest rates, I think biotech is set up for a huge rally, which is a lot of junior biotechs that fall into the penny stock world. I think would be great for you in the next couple of years.
Yeah. And again, it's kind of crazy, again, in penny stock land, because that's where I'm in, biotechs are always number one. It's and what's wild is, I think back to the last probably basically this year, this is the mid-year recap. They have been deader than dead. It's all been AI plays and all and all these other, and EV plays and all these other sectors. I'm struggling right now. Usually I got a pretty good memory. I'm struggling to remember the last, 400% biotech. And again, forward looking, that's the exciting thing, because all of you, listeners know that all these biotech, zero revenue, zero prospects. I mean, they need money. And if there's no hype in the market, they can't pump them up and then dilute. And then if they can't borrow money because interest rates are too high, that's why they're dead. And that's again, looking forward, why I'm excited, because that now we add, biotechs back into the mix as they've been dead for 6. I mean, I think of my 18 years of day trading, this has easily been the deadest 6 months of biotechs that I can easily recall.
Yeah, and you're seeing some deals go through. Some juniors have been bought, without a doubt. I think we're going to see a lot more deals happening in the next couple of years, where you're seeing these bigger companies come in that are we're seeing such a major shift in the healthcare landscape that some of these small companies have potential drugs or treatments that could change the world. You're going to start seeing them bought up. Because a lot of the big companies are sitting on a ton of cash. You don't have to borrow. So it's easy for them to go buy them. But good segue into, kind of our second half thoughts at this point. To me, there's really two big events that we know are going to happen. One is going to be interest rate cuts. Markets are predicting September, the first cut right before the election. Makes perfect sense. We talked about that a couple of weeks ago. They're only pricing in one. In the begining of the year, believe it or not, the consensus was between 4 and 6 rate cuts. We haven't had any.
I don't remember that.
Yeah.
I'm sure I forgot it, but yeah.
Yeah, it's amazing, and I was one of them, so I'm not going to bash the analysts. I thought, I don't remember how many, but I thought we'd at least have several, at least one by now. I thought we'd have.
I don't recall that 4 to 6 stat, but I was very consistent and not trying to be like, oh, I was right, you were wrong. I was like, they're not going to do it. They're not. I said that every Fed meeting. I'm like, they're not going to do it because, this is where my tinfoil hat, I got one around here somewhere. I got to find it. I'm just like, they're going to save their ammo into the election. I'm like, they're not going to burn this ammo, they're going to wait and they're going to try and do it around the election because they want to use it as a tool to garner votes. Now,
of course,
again, put the tinfoil hat on if you want, but
no. And the thing is, they say that the market doesn't, stock market's irrelevant when they come making decisions more about jobs and more about inflation, obviously. A lot of things.
Years ago, that was true, but
yeah. But so the thing is, the market's done so well, they haven't had any pressure to do it either. If the market was getting crushed down 15%, we probably would have seen one by now. They try to come in and save the market, especially heading into a presidential election. But 1 in September, pretty much priced in. Things can change, obviously, but I think it's going to happen. And I think we probably have one in December, too. I think we're going to end up seeing 2 by the end of the year. Point is, though, just to kind of tie in what we're talking about, when it comes to biotech and smaller companies, especially small cap companies that have yet to, no revenue at all, but most likely not making any money, so they're burning cash, they need to borrow money. If they're borrowing money at lower rates, that will be a positive. To me, 25 basis points or 50 basis points lower on the Fed funds rate doesn't make a big hell of a difference, honestly, for people borrowing money, but it's perceived, and perception's reality, right? So it's perceived as something that's really good for these small caps, especially biotech and others. So I think we'll see that. And then the second event, Tim, which we know is going to happen, maybe not, who the hell knows in this world, but we have an election coming. We have an election coming up, right? And then we had the debate last week where I was in a hotel room watching, and boy, that was an event. We don't need to get into that, but it was an event. And but Trump afterwards, regardless of what side of the aisle you're on, his odds increased dramatically after that, obviously, for reasons I don't need to mention, you can mention, but for reasons I don't need to mention, and obviously that happened. So we have that coming up, and that, to me, is going to create some volatility between now and November, because it's going to be going back and forth. Will Biden drop out? Will he not? Is Trump going to keep his lead? So it's going to be interesting, I think, for markets in the next several months.
And, and again, we don't, something I always say it 3 times like Candyman, we don't talk politics, we don't talk politics, we don't talk politics, but because it is such a hot button issue these days. Yeah. But, we're just looking at the data and like you mentioned, post the debate, like somebody, there were a lot of betting odds where they had the red line and the blue line. And as the debate's happening, and that's the betting markets, like that's, to me, that people are putting money in that. Like that's not me saying, oh, I like this guy or I hate that guy. Yep. That's the betting markets. And the red line just went straight vertical and the blue line dove. And, that's just the reality and looking at the data. And, to me, again, I think to me, and this might get me in trouble, but you look at a potential future president that was his entire past presidency was like pumping the stock market. He'd talk about it every day. And I think that was a big function of a lot of the runs, because when the president's talking about how strong the stock market is, you get, and I know I keep coming back to FOMO, but like the normal people are out there are like, what am I missing out on? And that, again, brings more money to the market, more money coming to the market. What's that do?
Yeah. And I mean, this is a generalization. I'll probably get shit for this too. But, a lot of people who are out there pulling for Biden and the loudest, the minority is always the loudest people in the room, right? They're just out there screaming. The far left and the far right, they're really minorities. Most of us are pretty center, in my opinion. The far bridges like that are far out.
That's all I want.
Yeah, exactly. But the people in the far, a lot of them don't invest in the stock market anyway. So it's not like they're really playing to the stock market, because that's not their game. They don't. I hate to say they don't have money, but they're just not. If they follow their true beliefs, money's not an issue. It's more social issues and more about life and socialism and kumbaya and that stuff, where the market's not a big thing to them. Smart people, big money, don't give a shit who the president is. They're gonna shift their money based on who the president is and policies, but they don't care. They're not pulling their money out. They're not saying, okay, well, Trump gets elected, I'm not putting my money in, or Biden gets reelected, I'm pulling my money out. Very rarely do you see that, because these big money institutions need to be invested, because people are paying them to invest. So if they're not invested, they're not making any money. So they're going to find opportunities out there. And yeah, so I think as we get closer to the election, we'll definitely do a show on the two candidates at the time, whether it's still Biden and Trump, and kind of sectors that we think will do well and be hurt under their presidency, which I think is a great show to let people know as we get closer to the November election.
I like that idea. Well done.
Yeah, I think it's a really good idea for us to do it. And we don't know, but we also want to do it prior, because you want to start positioning your portfolio. If you think, candidate X is going to win, and maybe want to, go in certain areas. Nuclear energy is probably good if Trump gets elected. Things like that, So I think we could touch on it as we get closer. But one more stat before I throw it back to you is, we had the S&P, as I mentioned, up 15% in the first 6 months. People say, well, maybe we had too much too fast, right? Which was my senior quote, which is a Grateful Dead quote, if you all don't know. And they say, well, too much, we have to naturally pull back. That's the defeatist mentality. You go with the trend. In reality, if you look back over the last 100 years, when we've had the first 6 months up at least 15%, which we were, the average return in the next 6 months is 7%. You say, well, it's not as good. But the average return of all the other years is only 5.7. So it shows us that even though we had a strong 6 months, it doesn't mean that we're due for a pullback. Historically speaking, we actually outperform when we have good strength going into July.
Right. Well, and I guess we'll kind of take it home here, but you got any you want to go on the record with any predictions here? Both election, overall markets, trends, etc.
I mean, I think I always hate to say the word ends at the end of the year. Like when I was on TV, you always had to give your prediction for the S&P is going to end 2024 at this level. I always said, I think at some point in the next 12 months, it hits this level, right? Because I don't know where it ends. Who the hell knows on that day where it ends? I think between now and the end of the year, from the close on end of June till between now and the end of December, the S&P will be up another double digit, at least 10% at some point along there. I don't know where we close, obviously, because that's a ridiculous crystal ball. But I do think that we see at least 10%. And I also think that the equal weighted, which I have money in there in the RSP, I own that, equal weighted will outperform by the end of the year as well.
I agree across the board. So basically, I don't have a counter to that because I agree with everything. Bitcoin. What do you think? Yeah. I mean, Bitcoin been sideways for like 3 months now. What do you think there?
Well, the big thing going on right now is the whole Mt. Gox thing, which was the biggest exchange that went under.
Yep.
So what happened was when that was kind of seized and stuff, they have to sell off those Bitcoins. So it's creating this supply demand issue where,
which I didn't. Sorry to interrupt. I didn't realize that was still going on. Like I saw that headline with Mt. Gox. I'm like, wasn't that like 10 years ago? But anyway, go ahead.
Exactly. Sorry. And actually, the payout over 10 years ago when the platform went under. However, they had about 950,000 coins, which is roughly $9 billion. So to pay back the people that get the money back, they have to sell these off. So FTX had to do it recently too. So you had this huge supply coming in that was being sold. So it kept, even though the ETFs had that big run up with more demand. So once this supply is off the books, that's going to allow Bitcoin to go. And historically, after the halvening, which we just had a few months ago, I think it was in April, you have this rally, then a pullback, and then usually for 12 to 18 months after that, you do well. So I think we're setting up at some point here in the second half of the year, Tim, probably third quarter, we bottom out in Bitcoin, maybe high 50, 60,000, somewhere around there. And I think by the end of the year, we could get close to triple digits, which means, or six digits, I guess, 100,000. And if Trump wins, obviously he's been pretty loud about being an advocate of it.
Yeah.
I just think there's the long-term story is too strong. It's too strong to ignore.
Yeah, this is angering me because I was trying to set you up for something to like argue with it, but I agree. Like I think with speaking of like too far, like there was all that hype about the ETFs, and then that kind of petered out, and then we have this news of again this liquidating, and I think agreed. I just think that kind of get through the summer of all this kind of nothingness, and then I was going to say second leg. It's probably the 10th leg, but and then takes off. Yeah, I'm just I'm a big Bitcoin bull. I own Bitcoin. I believe in it. I keep like this is one thing that a lot of like the listeners will misunderstand, because like I always say, never dip buy penny stocks. Like buy strength, but like Bitcoin, every day it goes sideways. I'm just like waiting for some sort of like big pullback because I'll be there. And we haven't had that in a few months. And I was actually. Again, that Mt. Gox news, I was like, ooh, what's this? I'm like, I didn't know about that. I thought that was over and done with. So,
I mean, that's really the last big one, though. When that does it. And keep in mind, we've had the FTX liquidations. We've had the government. The government seized so many Bitcoin over the years. They've been dumping theirs as recently as well into the market. So once all that's done, you have a pretty normal market where demand's going to outstrip supply, and inevitably you go higher. But again, and the good thing is, we're still hanging around, we're filming this on Monday evening. We're still hanging around 63,000. We hit 59,000 over the weekend. So we're back up 8% off that low. If we hang anywhere around 60 and that's your pullback, that's less than a 20% pullback with all this nut stuff going on. That's strength. That's long-term strength to me. So cool. I love it long-term. I think for the average person out there, if you're putting however much you want to put away over a year, do it weekly or bi-weekly.
That's what
you can't pick it, right? You can't pick the bottom. Nobody has any idea. It's so volatile that you're going to buy in at some prices where it's high, some prices where it's low. Over time, though, if it goes higher, best thing to do.
That's why and Bitcoin has historically done that. Like those big pullbacks. I always tell people, just like have some money ready so that when you see those big pullbacks, and keep in mind, be responsible. I'm not saying you dump everything into it, but have some money squared away so that you're ready for those. Because again, contrary to penny stocks, I'm a long-term believer of Bitcoin. And if you could just wait every few months when there's that huge pullback, and again, depending on where you're at, maybe it's a couple $100, maybe it's a couple grand, maybe it's $100,000, but like just average in over time. And obviously, if you look at historically, that's worked really well. All right. Well, thank you again, everyone. And again, as I always like to say, give us those comments. I think what are we, about 6 episodes into the relaunch here? Mm-hmm. I did keep the intro under like 20 minutes. So we both, Matt and I, are listening to you. So as always, drop us a comment, share with your friends, like, subscribe, etc. Have a great day, and we'll see you on the next episode of the SteadyTrade Podcast.